Good evening, and welcome to episode 111 of the Private Property Podcast. I'm your host, Uzamantungwa Kumalo. I'm back on your screens. It has been great to have a little break. Thank you very much to Esther for holding it down in Echo last week. And of course, it is Friday. We're wrapping up a really great week in property. And this week, we're going to be exploring the different ways that property investors, really successful property investors, find success through refinancing their property. And I'm sure you're probably thinking, what is refinancing? How does it actually work? Why would property investors even look into refinancing? And even exploring the difference between refinancing and flipping. That's some of what you can expect on this evening's conversation. And of course, we want to certainly hear from you. If you're a property investor, if you've ever refinanced a property before, how was that experience? I know that it can be quite an intimidating experience, especially if you don't know the process and you don't work with a team that will help you and guide you in refinancing your property or even different properties in your property portfolio in order to maximize your property portfolio. So do share with us how that experience was. If you're exploring doing it, what are some of your reservations when it comes to refinancing? Maybe you don't quite know much about it, then certainly do drop us those questions down here below. And of course, this guest this evening certainly doesn't need any introduction. We're going to be speaking to Taurai Jack, who's a co-founder of M5 Property Addicts. Taurai, thank you so much for joining us this evening.
Boom, boom. How's it going, Zama? Thanks for having me around.
It's always a pleasure, TJ. I think one of the great things, when it comes to speaking certainly to you and even some of your other business partners is you are the guys who are already doing this, right? We speak to a lot of property investors, certain people who watch the show are property investors, some of them wanting to grow their property portfolio and having the opportunity to speak to people who've already walked that path, have already made some of the mistakes that have cost them money along the way, is always so helpful because it also helps us not make some of those mistakes as much as possible. But of course, DJ, this evening we're looking at refinancing. I know that this is one of those, terms that gets thrown around a lot in the property investor circles with different investors saying, this is a potential way to maximize your property portfolio, to grow your property portfolio. So let's break it down to our viewers at home when we talk about, refinancing a particular property. What exactly do we mean?
Yeah, thanks, Zama. So I think the first thing that I want to stress out here is that, number one, we can never talk about refinancing if the people are not comfortable with the debt, right? And debt is one of those things that you can utilize to grow your portfolio. But from our background, when the moment you start talking about debt, people start getting scared. Don't take out debt. The only debt that you should take is your house. Now, there's two types of debts, right? Let's get that out of the way. The first debt is debt that we get so that we can go and buy Nando's and anything that is consumer. That's kind of like money going down the drain. So that's bad debt, right? Then there's good debt. Good debt is that you're getting the debt, but it's also putting money in your pocket. And that's what we're talking about here. So once we now understand that, or we are comfortable with the fact that we've got good debt, the next thing that we want to talk about, Zama, is in property itself, when you're refinancing, there's actually two ways you can do it. And I want to stress out the fact that the first one that I'm going to talk about is when you actually have a property and you have owned this property for a while. And what do I mean for a while? It's about you bought a property for 500,000 and you've been owning this property now for, let's say, about 10 years, 15 years, right? What has now happened? What has happened is that we all know that the moment you buy a property, it appreciates in value. So by doing nothing, the value of the property is going up. And by you also paying down on your debt, the value is also going up. So which means that
you build that equity into that facility. Yes.
100%. So you got that equity, and that's a new terminology for some of us. We might not know what equity is, but that's what it is. And I also want to jump into that. Sometimes when you're buying a property, you can actually buy that equity. And I'll come back to that a little bit later because that's another opportunity there. So for the fact that now you have been having this property for 10, 15 years, there is equity, the next thing that you can do is either you can go directly to your bank, the bank that where your bond is, and you can speak to them and they will literally refinance the property for you. So which means that you're saying, hey, I was about to finish my property, paying off my property for the next 5 years, but can you extend it again? So they will do that. So it's a new contract that is going to take in different banks have different terminology of this and different products that you can utilize. The point there, Zama, is the equity now becomes available to you as the individual, and you can literally do as what you want. However, when you're doing investments, for me, the tenant is now going to be paying off the same debt, but the money that I have now extracted, I can go and buy property number 2. And now I'm buying this property cash, right? So if I'm buying property number 2 cash, the first one, my tenant is paying that off. And potentially, if I gear it up, gearing up just means that you're buying the property to a certain level with the debt. I could be getting cash flow, profit, right? Now on property number 2, I'm buying this cash. So automatically, because I'm buying it cash, I've got a bigger profit, right? And I can recycle the same thinking that I've had on the same property. Does it make sense?
Yeah. And I think, one of the interesting things I've seen different, and I hope to viewers at home, getting a good sense. I like talking refinance with even some of the finance guys, because one of the things that they will take is in the event where you already, let's say you're able to buy a certain property cash, and you're able to even buy it, that property number 2, you're able to buy it cash. And let's suppose you're able to buy it at a really good amount, let's say at around 300K, but already properties in that area are even going, let's say, for 500K. And if you maybe do a little bit of work, maybe you can even push it to a 600K. That is already paid off because you bought it cash. Then you're able to even have that finance to access some of that money. So it's a good way to be able to extract money or value, not just from the first property that you've owned for quite a number of years, but even when you're now buying the second property, whether you decide you want to buy it necessarily outright cash because it's a low amount, or I've seen some people sort of spread it out, let's say buy 2, put down significant equity on 2 more simultaneously instead of doing one. So I think that certainly is a great model for for people to use when they, like we were saying, when you already have owned the property, perhaps you've been paying the bond for about 10 years. So you've already, and I think a lot of people who watch the Private Property Podcast, one of the tips that we always give is try to always put in a little extra every month, even if it's as little as 500 Rand every month. That does help you, especially if you didn't, for example, put down a deposit at the beginning. So then you've now built up that equity, and by the time you want to go approach the banks, then you can certainly use this model. So TJ, then so that's the first model, right? Where you essentially using, a property that you've essentially owned, and you're still paying it off, perhaps there's 10 years that you've paid off for whatever number of years. So then what's that second model that you were referring to?
100%. So the second model, Zama, which is what I do now, in one of my subsidiaries called the M5 Chart. And basically what we do there is that we put monies together with our partners, and it's all cash, right? And we go and buy distressed properties where a bank, if they would come through to see it, the bank would say there is no value in it, right? So once we have done this, because we've got the cash, we can take the risk. We understand we've got a team. We understand if we're to renovate this thing, how much is it going to be? So we know all of that up front. So once we've got that, the partners are on board, we go and look for the property, and then you turn it around. Turning it around just means that you're bringing it back to its former glory, or even better, right? And I want to give you a little bit of mathematics here, a bit of numbers, so that it can explain the deal. So I bought this property in Boksburg. I bought it for 700,000. And within this area, Zama, it's in a commercial area. So this property is a mixed area. Okay. And we went on to put in 400,000 on that property. So we're all in here now for 2.1, right? When we are done, Zama, what happened was that we put in tenants on there. We're now getting a rental income of 40,000 Rand. when we went to the bank, before actually we went to the bank, we went to our estate agent and to an evaluator. The evaluator came and evaluated the property at 3 million rand. Now, we only have 2.1 in it. That is hard.
But wait, let's go back there, TJ, because I'm sure viewers at home lost you there in the bit. So you bought it for 700K, and right. How much did you put into it?
Right. So we bought it 700. We put in an additional 400. So we're in it now on 1.1 million.
Yeah.
Right. So 1.1 million, we're only in it now. However, your rental now was sitting at 40,000, and the valuation came at 3 million. Right. Okay. Now, the bank, whenever they are seeing something that is fully functional, you got a rent roll, Zama. The property is clean. It's in a good area. You know what you are doing there, right? The bank is able to give you more than what you've actually put in, right? They're able to give you close to the value of the property because that's what they're seeing, right? In this case, Zama, I actually got out 1.5 million on that property, which meant that on my 1.1 that I had put in initially, that money, we got it back. And we got an additional 400,000. Yes, it might look like profit, but it's not really profit because it's debt still that you still need to pay down. But your tenant is paying it for you, right? And on your rental income, you got a rental income of 40,000, you can still afford to service that debt. But now what happens to the 1.1? What do you do with it? Or should I say the 1.5? What do you do with it? You take that again, you go on to project number 2. If project number 2 is identical to this project here, how many times can you roll this over and over and over? And this is where, for me and my team members at M5 Property Addicts, we get confused with people that buy this type of properties and then they flip them and sell them. Because for me, when I'm now looking at this, I still own the property. I'm still getting rent. Had I sold it, I would have only earned what? Maybe I would have sold it for 1.5. Let's assume that we're comparing apples to apples. I would have just earned 400,000.
And so then you're still going to get taxed.
Oh, come on. Don't mention that. Because a lot of flippers that are going out to flip, they don't even think up that far.
Yeah. You know, and you actually already touching on something that I'm sure that I wanted to explore after the break, TJ, but it's to understand that there's a fundamental difference between flipping, refinancing, especially if you're going to refinance the way that TJ has just broken down. And so you almost need to think, and this is one of the very important things, TJ, that we, always mention to our viewers at home, and a lot of guests also emphasizes that when you start with your plan at the beginning and you set out some of your intentions, it helps. So looking at what kind of strategy do you want to have? Are you going into property because you're looking at capital appreciation? Are you going into it just for cash flow purposes? Then it helps you when you want to make a decision whether you're flipping or whether you're going to keep refinancing and having various properties, because maybe for you it's about cash flow, making maximum amount of money, or even amassing quite a large property portfolio. We're going to go for a quick break. When we come back, we're going to look at that difference between financing and flipping, and I also wanted to take some of your questions and comments at home. I'm sure a lot of us probably do explore refinancing. I always say, TJ, to viewers at home, real estate finance is one of those things that sometimes trips me over quite a bit. In the other weeks, I was writing a long thing. It was like a 5-hour exam. So it can be quite complicated, but it doesn't always have to be. I think if you certainly understand the fundamentals and the basics, and by the time you speak to a professional, you at least have a sense of what you are talking about. CJ, so do take us through that difference between flipping and refinancing, as you're saying before the break. I think this is one of those things that people sometimes do make a mistake with. Bongs, I see your message there. saying that you need a blackboard now, you're lost. We'll definitely do a nice masterclass. I think this is one of those things. I promise I'll do a masterclass because I love talking finance. So we'll definitely bring in a masterclass and really do a good tutorial because there's so many different examples and so many different ways to refinance. I think this one will look at it as a nice intro to refinance. And I think keep those questions, certainly do send them through to us and we'll put in a really nice, masterclass when we dig deeper into this one. And I really see Bongs again saying, I really need to learn this. I think this is what I need to be doing in order to get rich. And I think, Bongs, I think a lot of people, certainly in property, people who are property investors who do this quite regularly, understand that there are various methods to growing and scaling your property portfolio, and refinancing is one of those methods. So you almost want to really master this and you're going to be set. So TJ, do tell us that difference, refinancing versus flipping.
Yeah, so Zama, I think this is almost right, one of those things that, it's a really preference thing, and I want to give the example to say that what strokes my boat doesn't really stroke the next person's boat, right? Mm-hmm. And that's where it needs to start off from. When I was employed, Zama, it was about exchanging my time for the money. And that I realized that I don't want to do. I want to exchange my time to be buying assets, and assets needs to pay me, right? So that's my investment philosophy together with my partners. We don't work for money. The way I see flips, Zama, is that you're a trader. You're buying at a low, so you're a wholesaler. You're buying at a low, and you're going to put your markup, whichever way you're going to dress it up, and you're going to sell it. For that reason, Zama, for the rest of your life, you're going to be working, because if you stop doing that, then you have no income, because your profits that you're going to be pouring in or pouring out of all of these properties, sooner or later, they're going to dry out. Whereas if you look at me from the other side, I'm accumulating assets by refinancing. My tenant is paying my debt out, right? So year on year, my rental is increasing if I'm buying in a good neighborhood, and my appreciation on my property is also increasing. So from a balance sheet perspective, my equity is growing, right? So I'm making more money there as well, right? And that's another secret, because by the time you're refinancing, the bigger your equity is, the better it is for you to refinance, right? And then on top of that, I have cash flows, Zama, where I am not working 100% in it. I can literally employ a property manager who might give it 8%, 10%, 6%, it don't matter, who's going to property manage my properties. And I get money for James by doing nothing. Mm-hmm. And that's the beautiful property for me, right? So if we now want to look at the difference, I've just given you the creed there of what is the philosophy behind it. And if that is, if any of these philosophies resonate with anyone there, then already you can choose, right, the path which you want to take in. But if I get a property, Zama, in Pomporaspruit, right, and by the way, there is no place called Pomporaspruit, but it's a very good deal. And I can literally put in 100,000 in there and I can make 400,000. For the fact that Pomporaspruit is far away from me, I don't know that area, I will choose to do a flip. Because it's an area that I don't invest, I don't know that area, I might never be in that area. It's an area that is not growing, and how can I make some money? I will make some money and I'll get out. But my primary business is to buy and rent. Why am I doing that? I can increase my affordability by income that I'm getting every month, right? Number two, my balance sheet is growing with the equity that I'm getting. Rich people, Zama, don't get rich by selling and buying. They get rich because they have assets that they've got. Once your foundation of your assets is great, you can take risk whatever you want to do now because your base is strong. And for me, that's how I differentiate the two in terms of flipping and where you're actually doing what we traditionally call rentals. So for that reason, it's really about what is really more enticing to you and your property journey that you want to do. I don't know if that makes sense.
Yeah, no, it definitely, it does, TJ. And I think one of the things I've already promised, viewers at home, we'll definitely do a masterclass, because I think refinance, whenever we talk finance, you almost want to dig a little deeper. Next level, we'll have that whiteboard or blackboard and start putting numbers up so that you get a really good illustration of some of the, the numbers that we run and some of the things that you really need to consider. I think a really big caveat to everybody at home is obviously when you're making some of this decision, certainly need to be speaking to, whether it's qualified accountant and people who understand what your financial needs analysis is going to be, who are going to do that and really help you structure your finances adequately. Because I think sometimes, as we were saying with TJ, some people you want to flip. So in the example that he made where, they put in 1.1, you're able to perhaps sell it for 1.5. You're thinking, oh, I'm just going to get 400K. You haven't factored in capital gains tax. And so your numbers then get thrown off. You probably haven't, factored in even transfer fees. So I think being able to look at then what are the other costs that are associated or what that would potentially eat into your profit margin becomes so important. But I think the really big thing with our conversation this evening is to already get you thinking about the different factors that you need to be aware of when we talk about refinancing. We're, of course, taking your questions and comments at home. We've got a comment here from some of our viewers watching on YouTube. We've got one here from Aaron saying that's a powerful statement and motivation by private property. We've got another one here from Andile Majola saying, thank you very much, guys. This is, this is adding quite a lot of value. Thank you very much for tuning in there, Andile. We also got a question on our Facebook page from Mkateko Ahape, who asks, is equity only determined by the number of years you have had the property, or if you're making additional payments towards the bond, then you also get equity faster?
Not necessarily so, Mika. So the other way that you can get equity on a property is, I think Zama alluded into it a little bit earlier on when we were starting off. We always talk about you can buy a property on a discount, right? So the same property that we gave an example of, to say that I bought it for 700 and I put in an additional 400,000. The normal value of that property at that time should have been 3 million had it been looking the way it was looking. So, but I bought it at a discount. Why? Because either it might have been a distressed building, or maybe it had just been left idle for a while, so it wasn't functioning. So for the fact that I bought it for 700, I have this 700 all the way to 3 million. It's a discount, by the way, right? So I'm buying it cheap. Same applies going to auction, you're buying it cheap, right? What you're buying is equity there. You're actually buying that. For those of us who understand accounting, the moment I buy that property and I register it in my book, from an equity perspective, my balance sheet shoots up because the real value is 3 million, but I actually bought it for 700. So which means now the difference here becomes money that I have on my balance sheet. And if I'm to go to the bank, they can actually give me that the difference there of what my equity can carry. So banks will look at it differently in terms of risk, in terms of you, the individual. But the point is that you have enough assets on your balance sheet. And when I started understanding this, Zama, that's when I was like, I think I love this property thing. Because the more you buy on a discount, the more your balance sheet is growing. So you kind of like having free money, if we call it that. So my right now, my most important skill in my business is negotiation. Because if I know how to negotiate, what to negotiate, when to negotiate, I am literally buying by just having the conversation and writing it down and signing. I'm banking a couple of millions if I can.
And I think, TJ, something to also bear in mind, especially for, the investors who are probably still, starting out. So perhaps you're buying, let's say, one investment property, maybe a 1 bed or a 2 bed. because I think that, TJ is now at that level where you're looking at sort of block at flats. So even the way that you look at that asset, the way the rental split works, that it's sometimes mixed use is slightly different. Because the risk is also spread quite nicely. So I think, Gateko, I think one of the ways to also just look at putting in more equity is, like you're saying, where you add in a bit more. Sometimes it's even if you get granted 100% loan, so the 100% loan to value, if you've put down that deposit, that's the bit that you essentially have equity on. I mean, I know some of the investors I've spoken to who use really interesting, and it speaks to what TJ was saying, where suppose a property you're able to get it for 500,000, but let's suppose it is selling for, let's say, 800,000 in that particular area. And when the bank comes and evaluates the property, they're able to extend that 800,000 loan facility to you. So you go and register that 800,000 at the deeds office, and that you've bought it for 500,000. You still need to qualify, obviously, for that 800,000. You now know that when you want the cash from the bank, you're able to access it because it's money that's already been there. So there are different really interesting ways to look at accessing money from bond facilities, where sometimes you're adding in a little more, sometimes, as TJ is saying, certainly get really good discounts. And the big thing, as he's saying there, when it comes to getting really good discounts, is being able to negotiate. Now, TJ, I do have to, wrap up with you. I think the last question that I want to put to you is from, one of our, from our guests, who says, I want to refinance, but I don't think I will qualify. What determines whether you qualify for the equity amount or not?
Run the question again, Zama.
So Portion Damasa says, I want to refinance, but I don't think I will qualify. What determines whether you qualify for your equity amount or not?
Oh, okay, great. So whenever you're wanting to get more money from the bank, right? And this question of I don't think we should do away with it, and let's just do the checks, right? That's why bond originators are there. They don't charge you anything. And that's why your bank is there as well. You can quickly go in and check, right? Then we get that maybe not, out of the way. Now, it depends here, right? Let's assume on your property now, you've got about 300,000-400,000 of equity that you can tap into. But the qualification now is a challenge. I want to stress the fact that different banks will look at it differently, right? Yeah. So now we have started seeing banks, this wasn't the case like 5-10 years ago, where banks will sort of like, is this the property that it's an investment property, so there's a rental income that's coming from there. That's scenario number one. So we can take 70%, 80% of that rental income on that property, right? So it's no longer about you alone, who's the person who is funding this. So it's you plus maybe a 70% of that property that you own. If it is your own property, then you don't have a tenant on it. Yes, that might be a challenge. However, a bond originator could then look at your circumstance, right? And could maybe advise you to say, at this moment, refinancing might not be the best idea with your bank, right? Where you are, let's assume Standard Bank. But if we switch to FNB, FNB is going to give you X amount. So they will do the homework for you. And with that, you don't have to do anything. Give them paperwork. They do all the work for you. And then boom. So you might not get to the 0300, but you might get 150. But what can 150 do for you? I've bought a property for 160 before. So there's options.
And there definitely are options. TJ, I think we're going to leave it there this evening. And it really has been a pleasure to have you on the show. It's always great to have you on. And as promised to viewers at home, we definitely are going to, have a good masterclass. We'll bring in a masterclass. I know I've promised even one on restructuring. So we'll definitely do this one. I see Paul Adams there saying, I just want to thank TJ for being TJ. He doesn't only share his knowledge, but his personal experiences and doing it so unselfishly. unselfish, what is that? Unselfishly. This is what happens when you're like trying to read the screen that's far. And also my English bundles are slowly running out. And he's saying you're just amazeballs. Thank you, M5 Property Addicts. Thank you very much there, Paul Adams. And I think I'm going to leave it there because I'm running out of my English bundles. TJ, thank you so much for joining us this evening.
Thank you, Zama. It's been great. Have a great weekend.